So this is what I'm going to say for this class. This is going to be the only intro we're going to do for vol. So if you're new to volatility, it will be all what I will do is basically I'm going to use our whoopsie. Oh my gosh, I totally messed this up. Hold on. That. Master class. So this will be so for some of you that have taken gold and platinum, it'll be a few slides from the gold, but the rest won't be for this one. Just because for intro vol, there's not much else that we do with that. What I do want to do at the end is get into kind of the concept of what I believe a vol pair is. So this is kind of option pit method. This is I don't know what other people where you come from. So essentially, for all you new people, my name's Andrew Giovinazzi. I was a floor trader for 15 years. Basically, retired from the business in 2006. I actually tried to start companies and stuff, and that's really hard, so I ended up back to trading with Mark in 2011, when he just started this business. So I've been doing the teaching. I used to teach trading to other market makers when I worked for Group 1 and I had my own firm. So what we tried to do at Option Pit is we tried to take, let's just call them professional techniques and translate them to retail trading. That's what we've tried to do. So the difference is when you're a liquidity provider, you take the other side of lots of trades. Hold on for 1 second. He's still having trouble. Okay. I keep sending him a link and he is not getting it. All right, he'll get it though. So that's what we have. But the difference is for retail traders, what we're trying to do is teach you where there's some edge in a particular product. And in this intro class here, we'll talk a little bit about what edge is, what volatility edge, and the reason that it exists essentially. So if there are any questions at the beginning, again, this is what I would say would be like a basic intro to vol. Next week we'll do more Vega weighted, Vega dropping, how that affects the position choice versus other things. And then we'll go get essentially into the VIX as a direction. The whole idea for this is, you just want to trade volatility as a direction to the extent possible. And then we'll outline in the beginning here why you want to do that. But as one guy's trying to get in and he's still having trouble, and I sent him multiple links. But, all right. Any other questions before we start? And so I've timed these to be about an hour or so per. Again, if you have questions, put them in the chat window. And then we'll see how things go. All right. Okay, so first our disclosure. The materials presented for option pit information purposes. If you lose money, it's your own fault. We're not responsible for losses. You're responsible for everything. Here's our disclosure. Okay. There we go. So this is where we want to start. So this will be our basics, okay? Just variance and volatility. First, we're describing just what it is, okay? And then I basically think what I think it is. So I don't spend a lot of time with the minutia of the math behind variance, right? Because ultimately, if you could trade you don't need it a tremendous amount, okay? Which is kind of what the point of today's course is. What you're trying to do is just recognize price volatility and help and put a number on it. Okay. So why we trade it? I think there are unique reasons, right? Volatility as a direction trades different than underlying price for the reasons I'll describe today. It's key that you understand the three basic tradable vol concepts: IV, HV, and forward vol. Okay. Another key concept today is straddles. Okay. Straddles is pricing mechanism. Then I've got, this is what I used to teach beginning market makers, SIBO, PCX, Amex, Philly, everywhere. Okay, just the cyclicality of volatility. Okay. And last, the concept which we're going to introduce, which would be a permanent concept, is one of a vol pair. And this is where I expect you to ask a lot of questions, because the vol pair to me is our volatility arbitrage, which is a central tenet to what we try to do. Okay, it's basically buy low, sell high. But you have to recognize the instruments. Okay, there's our disclosure. I don't like that I have this backwards. So, basic concept for volatility is what I think about this sometimes too for normal distribution is you think about too is if you bounce a ball, you just keep bouncing a ball, right? It's going to move. It's going to bounce some, right? You try to think you're giving it the same amount of power. It's going to bounce. It's going to come back. It's going to bounce. It's going to come back. It's going to bounce. It's going to come back. A lot of ways, I think volatility is kind of like that. Bounce a ball, don't know how high it's going to go. It's going to go some height, but you don't really know. There's probably some upper limit to how far it can go. Probably even a lower limit to how far it can go. But ultimately, you just don't know. One of the key assumptions for vol trading in general, though, is stocks. The big assumption is, you don't know. It's almost a coin flip whether stocks are going to open up or down the next day. Just don't know. What you can do is you can measure. So for stocks, I could look back over the last year and you could just create a sample of data, right? So 68% of the time, how far did the stock move up or down from the closing price? So we'll take the closing price as the mean, which is you. And, right, 68.2% of the time in a normal distribution, right, which we call one standard deviation from the mean, how far did the stock open or trade from the close? Right. So 2 standard deviations is a little bit more, 95.4%. So one thing that you want to notice is between 1 standard deviation, would you qualify that as most of the time at 68.2%? Right. So if you're thinking about it, 1 standard deviation at 68.2%, and feel free to type something in and say, yes, Andrew, I agree with you, no, I don't, right? Because I want to make sure you understand some of the basic stuff before. But 1 standard deviation, that's like most of the time, right? Michael, you made it, that's good. Right. 2 standard deviations at 95.4% is a hell of a lot of time. A hell of a lot of the time. Right? So if you can create a trade where you think you can win up to 2 standard deviations, if you can convince yourself that's a winner, I would say that's a lot of odds in your favor. Like 95.4% of the time it's a winner? Yeah. Right? So what we're trying to do here is starting to quantify things. So for volatility, right, this is the assumption that we make. Right? One of the assumptions that we make is that stocks are going to follow sort of a normal distribution. and we're in a bear market and things are ugly, you take all of this normal distribution and what do you do with it? Right? You chuck it out the window. Right? So when I immediately say something when you're trading, right, the first thing you think about is, when do I have to think things are going to be quote unquote normal? And when are things not normal? Does everybody get that? So if you're going to trade vol, if you're going to be a vol trader, don't you think that's important? Right? I would say right now it's kind of just normal, like not much is going on. Okay, that lends you to think certain types of ways. Okay, another concept here is you trade what you see, but you hedge for what you don't. Okay, because if everything worked just how we saw, life would be pretty easy, right? But after trading options for almost 25 years, a little bit longer than that, I've noticed that it doesn't quite work that way. Okay, so again, going on with basic definitions, if a distribution moves within a normal range, it's called a variance. Stock prices, right? You can call that a normal range. Okay, a distribution of prices. It's a normal distribution over some period of time. For stock options, Black-Scholes chooses a 1-year period. Okay, that's why it's important. The model likes 1-year periods. Okay, that's what we'll just call normal. Okay, so what you're trying to say as a variance is when you have a variance or distribution of data, stock prices is a distribution, what you expect the data set to vary most of the time. So when you look at a normal distribution, you look at last year's prices, you're just going to say, how much did it move most of the time? That's the only thing we're saying with volatility is, how much did it move most of the time? Okay, how much did it move? Okay, the term we use for that is volatility. So you have a range of prices. You're trying to quantify that in that range of prices, how far do we move? Okay, but with volatility, we stick a number on it. Okay, so a 20% volatility, let's say, it's 20% of the stock price up or down. Okay, so that means on a $75 stock at a 20 volatility, our straddle value is going to be 30 bucks. Okay, on 2 standard deviations, our straddle is going to be 60 bucks total. Right, so a $15 straddle can move. A $15 straddle can move $15 up and $15 down for $30 range. On a $30 price, you can move $30 up and $30 down on the same straddle. Okay? So don't forget, with the normal distribution, up or down does not matter to the normal distribution. Okay? Yeah, all these people want to log in. Why did they wait till 20 minutes after the presentation to ask me these questions? So now, what we care about as traders, annualized periods are fine, but how many people trade options on an annualized on a 1-year hold? Not many. Some do. Unless you're with the hedge fund guy. What's his name? So what we use with standard deviation is we're trying to take an annualized volatility, right, the square root of the variance, and create a non-annual period. So from a vol point of view, we're just taking our number and you're taking the square root of the new period. Okay? So mathematically, you have a 20% vol on a $100 underlying for 1 day. So I'm just trying to say, what am I expecting this thing to move on an average day? Right? That's all I want to know. Okay? It's nothing earth-shattering. So if you're, hold on. Where was I? I'm not answering anybody. If anybody's trying to get in now, they're out of luck. So 1 month of trying to get people to sign up. Anyway, so what? Anyway, where was I? Okay. So we have a 20% vol, and we're taking the square root of 1 over 256, which is basically one trading day out of 256. That's all we're looking at. Okay? So we're trying to price what 1 day is. Okay? 1 day is our new period. Basically trying to make fractals of the annual time. Vojo, if I'm saying your name right, exactly. Because as this course goes on, we're going to look at 1 week, 2 day, 3 day, 5 day. You price that thing, or you're looking at those things slightly differently than you're looking at, say, a 3-month or 6-month type trade. The fundamentals are the same, but the things you are trying to capture are different. Does that make sense? So on a 1 day, on a 20 volatility stock, okay, you're expecting basically $1.25 per day in movement, right? So if you're expecting $1.25 per day of movement on 20 vol, right, every day, right, that's an expectation. So if I'm trading something and somebody's paying $5 for a 1 day move, wouldn't that get your attention? Okay? Would that get your attention? Yeah. If somebody's trying to sell you a 1 day move for 25 cents, would you be interested in buying it? Does that make sense? So if somebody's trying to sell you a 1 day move for 25 cents when the stock's 20 vol, you wouldn't be interested in that. Okay, you would. So you're back on the program. Andrew, you made it in. Good. So what we want to do as vol traders, exactly. Thank you, Michael. Former students are coming in. Right? We are trying. All we're doing when we come with the concept of vol pair, right? Vol arb, is we want to try to find things that the market is pricing what we believe mathematically are too cheap, or what we believe are mathematically too expensive. Right? The purpose of the class, this series, is to help identify those things. So when you go into a market and you go cold and you're looking at data, you can make rational judgments. Does that make sense? The most important thing about volatility is it has a time component. It could be hours, days, or weeks. Meaning it's volatility, right, for 1 week, right? Volatility for a 1 or 2 day period means something different than volatility for a 3-week period, right? The time's critical. So when we start to analyze trades, the amount of time you might be in it makes a difference. Okay? You want to see how the market is actually pricing that, right? And we're going to give you some rules for this. Right? Any questions about this? Okay? That's right. I'm not rewriting the book on standard deviation with this. Okay? All of this is, I would just call it known. But you have to understand what you're looking for, right? Because it's important to know things for a price. Okay? At Option Pit, these are basically the 3 types of vol, although there are more. There are more, and we'll talk about more. But these are the ones that I want you to understand why and how they get where they are. Okay? The first one is a forward vol. Black-Scholes wants forward volatility. What's the volatility between now and February 20th in the SPX? Is there anywhere where you could figure that out? The futures. Okay. How many people do you think look at VIX futures prices on a daily basis? There's at least two, right? Maybe three. So the VIX futures price, right, and this is important for us, Tarzan magnificent, not the average investor, which is actually good. Exactly, Michael. Their best guess is you don't know the future, for sure. Okay? That's what I say here. The VIX futures try to guess the forward vol. But what's important about the fact that these futures exist, right? What we'll talk about by, let's say, probably class 3 is how many products trade on this perception, right? A crap load of products trade on this, right? So all of a sudden, right away, you set up the what? You set up the possibility for a disconnect between what is happening and what the market thinks is going to happen, right? Because what the market thinks is going to happen, you could actually trade with a VIX future. Does that make sense? So for us, okay, I'm going to make a bold assumption for this. We're going to assume that the VIX futures are correct when we price them for what's going on now. However, they won't always be that way. Does that make sense? So we're going to use them as a pricing mechanism when we look at vol products. But also, once we understand the nature of volatility, we know they're not going to stay right for very long. How often does the front week future hit cash when it settles? I'm going to say all the time. Right? But that's, again, the future eventually does become correct, right? So what this is we are looking for signals. We're looking for signals, and the concept of trading vol and vol pairs is you look for a signal, and then you try to build a position around what they're giving you. Does that make sense? So right now, if you look at this and the Feb, the Feb ordinary future, which I believe is the 15th, Feb 15 future, and that was trading 1850. Okay, right now it's trading 1465. But if it was trading 1850, would that not get your attention? Right? It does. You're right, because when I give you an outlier like that stands out, don't you automatically think, well, something's going on there? Right? How do I find a way to sell that? Vojo, how big is the usual spread between the VIX cash and futures? We're going to do a whole class on that. Right? So when you ask that question, what you have to say is, how big is the spread for what period of time? That's right. So now we talk about volatility, you talk about for how long. You can't talk about volatility anymore after today without saying for how long. Okay? But if you just see this data like this, a sheet, a table, and you see 18 vol for February, like, why the hell is it so expensive? How the heck do I sell that? Right? Automatically, you get pulled in to that. But if now, let's get into the real world. What happens if that future is 50 cents too expensive? Right? Would you notice it? If that Feb future was 50 cents too expensive in this table, would you notice it? Right? Probably not. But what we want to be able to do is when something feels a little expensive, again, that's just the education part. When things are a little expensive, we want to make sure we're on that side, right? So we go from like $4 too expensive to just a little too much expensive. But all of you guys that have traded the vol products know how much 50 cents in the futures means to all the vol products that grab value from those futures, right? That 50 cents actually can be quite a bit as a percentage of VIX. It could be 5%, right? Right? It could be 3 or 4%. Now, if you're creating a trade where you know the underlying is going to move 4%, right? Where you're confident that that's possible, isn't that something that you want to look at? Right? That's the purpose of the class. Okay? Helping you to feel when things are are starting to misprice when the options are not giving you quite those prices. Okay. Okay, so this is one type of vol, forward vol. We don't know it, but for our class, for this masterclass series, we're going to say the VIX futures is basically telling us where the market's going to be for vol. Okay? It doesn't mean it's right, but that's where we're going to take that as a number. Okay? The next one, okay? Again, I'm not trying to over-exaggerate, but how important the idea of implied volatility is. Okay, implied vol is an output of the model and derived from market prices. Okay, so who sets volatility in option prices? Question I ask all the time. Right? Supply and demand, but the liquidity providers put it there. Right? The liquidity providers put it there because supply and demand makes them do it. Okay? As a liquidity provider, I try to push the volatility to places. So if something wasn't happening in a stock, I try to drive the vol as low as I can so I could buy it up. Okay? If there was activity in a name, I would pump the volatility as high as I could get away with to see what I could sell. And then as soon as somebody smart figured it out, I'd lower my bid again. Right? It's kind of like I'm a McDonald's franchise and I'm trying to see how expensive I can charge for a Big Mac. Okay? Probably at $10, I would run out of customers. Okay? The difference in the option market is if I try to put a $10 bid up for a Big Mac, somebody would smack it. Right? If I try to sell a Big Mac for 25 cents, although maybe nobody wants them anymore, but every once in a while they're okay, you would find buyers, right? Does the pricing mechanism make sense now? So the liquidity providers seek, right, since it's almost all computerized now, they seek their creating equilibrium in the marketplace. Okay? What that does, though, is does the buying and selling of options have anything to do with what they're actually worth? Right? It doesn't. It doesn't. Right? So we've already identified two places for potential arbitrage. I don't see the difference between IV and forward vol unless by forward vol you mean theoretical. So forward vol, Mauricio, doesn't exist. Right? Because if I'm asking you what the volatility is going to be between now and next week, or now, let's say, in February expiration for VIX, you don't know what that is in any certainty. Okay? What I'm saying with the VIX futures is you are getting a volatility number, a direct vol. It's not a derived number, right? So when the VIX futures 1550, you can sell it. Does that make sense? They're telling you what the forward vol they think is going to be. That's what the market's trading it for. So in one way, that's certainly the market's creating the price, the vol price, but they're also giving you a specific number, right? Option implied volatility is backed out of people selling calls. Right? It's a subtle but not huge difference. But forward vol, remember when I said in the previous slide, right? It's not the exact vol, it's the market's what? Guess for forward vol. In our class, we're going to use the futures as the guess for forward vol. Does that make sense? So when we start putting together positions at VIX, and I ask you, Mauricio, where's the vol going to be tomorrow? You're going to look at the VIX futures and you're going to tell me. Does that make sense? Okay. Okay. The implied volatility is telling you what they're going to pay today, depending on which implied vol, right? Here, the Jan 13, this is volatility for, well, this was for Friday's vol. You have volatility for Jan 17. Again, these are derived numbers from option prices. It's not the direct vol bid. And like I said, as soon as we get a sense of where vol is from the futures, after we make that assumption, our next assumption is that it's going to what? Is that it's going to stay the same or that it can change? With the vol futures, your assumptions will be that that number will change. But what it's giving you is a direction at the beginning. Okay. You made it sound like the VIX moves toward the front month future. I thought the front month future moves toward the VIX. Well, I can give you a sample like this. So, Wayne, if the VIX cash is trading 18 vol, right? And the front month future is trading 20 vol, the assumption is going to be for future volatility to be what? Higher or lower? Is higher. Okay. Now, after we make that assumption, how are we going to price that? Right? What I want you to be able to do is look in the market and saying, what is the market telling you right now? So if you go into a trade and you see the VIX futures and you're saying the market is telling you that, right, the futures are saying volatility is going to be higher than the future, that's what it's telling you right now, right? Does that mean you just go blindly buy some options because you think the volatility is going to go higher? Right? It's just like when we're in backwardation. Right? When we're in backwardation, that means VIX cash is higher than the future. Right? And when the VIX cash is higher than the future, right, do you just go sell options immediately into that? Right? You don't, because you know there's something else going on, right? Generally, when we're in backwardation, something else is happening. Okay? What I want everybody to do is, when you see a future, a VIX future in a spot, you make an assumption about that spot, what the market sees. Okay? Then what we're going to do is we will price a trade for that. Does that make sense? So when the futures are, when a VIX future, right, in our example, when those futures are priced a certain way, that's telling you something, right? That's telling you certain things. Right? It's just like when a VIX future is really cheap when we talk about that relative to the cash. That's also telling you something, right? But you have to, what we want to do is we want to figure out where the edge in those trades are, right? The futures are here, the VIX cash is here. When does it generate a trade? Right? Because remember, the first thing it says, once you make the assumption, your next thing is that is going to change. Right? Because when we look at vol charts, a volatility chart one day probably looks different than the volatility chart the next day for implied volatility. It was here, now it's here. Then it's there, now it's here, right? Right? I didn't say that the VIX cash is going to go to the future at expiration. What I'm telling you is this is where the market thinks the forward vol is right now. Does that make sense? Right now. Right? That's a loaded statement. Right? Does that mean they're right? No. Right? It's like the implied volatility when you trade options is a signal. What you want to be able to do is when you buy an option, you want to know what you're paying for it. What's the volatility I'm paying for it over some period of time? What's important for implied volatility and IV30 in particular, okay, is IV30 is an extrapolation of volatility 30 days from now. Basically, they take the options that expire just before the 30 days and after the 30 days, and they interpolate a volatility number. That's essentially what the VIX is the IV30 for the S&P 500. Okay. But we're not even talking about VIX yet in general. Okay. All we're talking about is implied volatility is the volatility output from market option prices. Does everybody understand that? So if I say, what's the volatility of those options right now on the Jan 20 cycle, you'll go to the at the money and you'll tell me. Okay, so what's important for our course is if I ask a question or I'm explaining something, you know where that volatility number is coming from. Does that make sense? Right? If I say the VIX futures are pricing the forward vol expensive or more than it's trading for right now, you'll know why that is. Okay, or you'll know what that is. VIX is trading 16, they're pricing the future at 18. That is clearly the market not thinking vol is going down tomorrow, right? If VIX is pricing the cash at 20 and the futures at 16, the market is clearly thinking vol is probably going to go down tomorrow, right? Or at some point in the term of the future. Again, we'll hit that when we hit VIX specifically. But for now, if somebody's asking you what the forward vol is going to be, you look at the VIX future. Does that make sense? That's all you need to know. The premium of risk is in the futures. Yep. It's a good way to think about it. Right? Because almost all of the rest of the course will be based on that. Right? If you want to trade the vol products. Because if you want to trade the vol products without understanding that, then you're pushing a rope. Okay? Here is probably historical or realized vol, I should say, or realized. Here, let me fix this slide. Okay. All right. So the most important thing about realized volatility is it looks backwards, meaning what happened last week. My time period for realized vol is we just use close to close volatility with lots of different measures. What I recommend if you're going to trade volatility is just pick a measure and stay with it. So if you're a close to close vol, that's fine. If you're average true range, that's fine. There's lots of arguments about which vol is better and which more accurate or whatever. That's whatever that is. I don't care. So all I care about is it's important to me that you kind of keep the same type of measurement throughout the cycle. The former DPM uses close to close because he's too old to change. Right? Mostly because I have a feeling for what that vol is. Close to close vol at 8%, I know what that feels like. Okay, close to close vol at 100%, I know what that feels like. So what you're trying to describe is the activity of the underlying you're looking at. So if the realized volatility of a stock, which I call basically kind of the personality of the stock, if it never gets above 20% ever, that means something, right? If you're trading an underlying that never gets above 20% volatility, that means something. Right? Because what did we just say about standard deviation? What's the biggest takeaway from that whole concept? Right? The biggest takeaway is I'm trying to price 20% volatility means a $1.25 move for a $100 stock per day. That's it. HV on the slide is trading days. IV is in the calendar days. That is correct. It's for today. Implied volatility is always calculated from right now to expiration. Okay, but it actually includes the weekend, so they discount it, then they reinflate it, then they discount it, they reinflate it. So we'll talk about that when we talk about Vega in the next class. But you're right. Realized volatility is trading days. Implied volatility is all the days to expiration. So if there's 30 days to expiration for the IV calculation, they're looking at all 30 days. And then remember, Wayne, they have the weekend effect where they discount the implied vol because they take the juice out, which drives the implied vol down, and then they pump it back up on Monday. Right? That's in gold class 4. So weekend effect. If you don't understand that, let me know now. Is that tradable to drop on a Friday, up on a Monday? No, because they discount that they start discounting the weekend by Thursday usually. It's tradable if they pump the vol up on Friday because you know that there's 2 days that nothing's going on. So Wayne, when you go to the Option Pit website, go to gold class or weekend effect. No, what they do actually, they don't discount the futures. They leave the futures at the price they are, and the cash fix discounts and then rises. The no free lunch of friend. I think, Mark, what is the acronym? TANS TAFL? There is no such thing as a free lunch, which is why we use that. Okay, what does all this stuff mean? Right, I'm supposed to have a 1-hour class, and I'm only got 10 minutes left, but we started late. The SIBO said in a recent webinar that the discounting takes place on Friday p.m. Yeah, Mauricio, I traded the SPX. It does not. The SIBO doesn't make markets. Yes. So put it this way, Mauricio. Yes, the market makers are going to sit there and put a bid up for the weekend until the last 5 minutes of the trading week. Now, if you were a liquidity provider, would you do that? Yeah, I'm going to keep a bid up even though I know that 2 of these days are going to be worth nothing. Would you do that? Not a chance in hell. No way. Right? Sometimes they start discounting on Wednesday afternoon. Because if nothing's going on, they're going to let the bid slide. But if there's any action, they'll bid it up in a second. Right? But that's also something we look at for trading these weeklies or trading these daily options. Because sometimes they do. They take the weekend out midday Wednesday. So you almost have 2 extra days for nothing. That's an opportunity. Again, that's like this, with standard deviation. They're letting you buy something for $1 that's worth 2. Okay? There's no guarantee you're going to make money on that, but don't you think that's a good place to start a position? Okay. So, if you've all had, I'm not going to read the stuff on the right. Okay? There's an important thing here that I like. I like this slide. So all the people that are in option pit, tell me why I like this slide, besides the fact of the waves. Because obviously a vol chart looks like waves, right? That works very well. What's my favorite phrases in here? Right? Waves travel because gravity pulls. Right? The most important thing about trading volatility is the concept of vol gravity, meaning things tend toward the realized vol. Right? Mean reversion is the popular term. But if I just say, what I've decided is, if I say mean reversion, does anybody really know what the hell that means? Because to be honest, I don't think it's hugely helpful. People know what mean reversion is, but put it this way. Rubber band is nice, right? But what's important about volatility is there's a force on implied volatility to realize volatility. Does everybody understand what I just said? There's a force from implied volatility to realize volatility. Meaning how the options are being priced is moving toward how the underlying is actually trading. Does everybody get that? That's the wave. The problem with mean reversion as a concept is if we're trading at 30 vol for VIX, okay, we're not even talking about VIX yet, but I'll say if you're trading at a very high vol, right, mean reversion says we're going to go down eventually, right? That vol's coming down. No, it's going to go down. The problem is in the meantime, you can go from 30 to 40, right? And you've lost all your money. So mean reversion will happen eventually, but that might not help you with a position over a certain period of time. Does that make sense? So if you're going to say mean reversion and you say, well, over the long period, absolutely. Over the time period you have your options, maybe not, right? It can be no bueno for you. Does it make sense? So my wave theory is what's important is the cyclicality of volatility. And the cyclicality for the time period which you are interested in trading in. That's all that matters. Right? Is what's going to happen when you have a position. Everything outside of that matters not. Right? Semi-Yoda-esque with that. Okay? Notice the VIX. It goes up, it goes down. It goes up, it goes down. It goes up, it goes down. So right now, you would make the assumption that VIX is pretty low. It's at the bottom of the trough. It will eventually go back up. Right? So, does that mean you go and buy options in the VIX right now? Right. That's right, Benny's saying with mean reversion, you get periodic. So you can have highs within highs, and you can have troughs within your lows. You can have all kinds of crap. Right? My assumptions, but here, what I do is, so the VIX again does look, right, and a lot of vol charts look similar to this, although VIX is kind of bouncy sometimes. There is a cyclicality to VIX. Okay? What's important is that you can trade down here and that you can trade up there. Okay? Part of this course is going to teach you want to be able to make trades when VIX is 24 and a half. You want to be able to make trades when VIX is 12. One of the things about Option Pit with our strategy 11 and all that stuff, and I don't do everything perfectly for sure. But what we are able to do is when VIX is here, we can trade. When VIX is here, we can trade. When VIX is 35, we can trade. Okay? That's important. Because if you're blown out at the bottom and you're blown out at the top, it doesn't matter. Right? So let's move. These are observations from, I don't know, 5, 6, 7 million option contracts. I don't know anymore how many I traded. Okay? My big one is really surprising. Vol moves in a circuitous fashion. Okay? It's like the weather. If you don't like how it is right now, just wait a day or two, it'll change. However, these are some of the things that I noticed. They're not absolutes, but they're most of the times. Right? And as far as option trading goes, most of the time usually is good enough. IV is constantly against the effects, should that be an A, of time. Right? So current realized vol must hold up. So your wave riding is not quite the same as mean reversion. Andrew, it is absolutely not the same as mean reversion. It is more about HV versus IV pulling. That is 100% correct. Right? So for all of you that have taken the gold course, right, we talk about liquidity. The reason is IV is constantly against the effects of time, right? Constantly pulling on it. So your realized vol has to stay where it is, or something else is going on. Does that make sense? You can't pay, remember, right? We just said at the beginning, standard deviation. When you take an option pick course, everything on the slide before you have to know for the next slide. It's really annoying. So if you're trading something that's worth $1.25, or it's priced $1.25, but the realized vol is only, let's say, pricing 25 or 30 cents, how long is that $1.25 going to hang up there? Do you see what I mean by I'm saying I'm taking the realized vol and taking an implied vol and I'm creating prices out of it? Right? You can't have a 20 vol option if you don't have 20 vol movement for a sustained period of time. Does that make sense? It just can't exist. Right? You don't want to pay $2 for something that's worth $1. You just won't. You know who's going to do that, right? But that doesn't mean it can't get there sometimes, right? Right. These are the basic fundamentals of trading volatility and trading the vol products. Right. IV will drop at its first opportunity. Okay. Now you could put all this stuff up, and there are people that will argue with some points, but I'll tell them whatever. I don't care. Yep. Nick is right. So it's much easier to make money selling vol when VIX is low, and then VIX is high. The smart in a way, Vojo, if I'm pronouncing your name right, yes, but it's how we choose to sell it. Right? Part of this course is how we choose to sell it. Right? Because what you want to be able to identify from this course, the idea of what a vol pair is, I want to sell something that's relatively expensive. And I want to buy something that's relatively what? Cheap. Does that make sense? Just because a VIX is 12 doesn't mean there might be something that's more expensive than that, right? Does that make sense? The part of the course is you want to be able to identify that. I want you to see a number and say, that's a 12, that's a 16, I buy the 12, I sell the 16, I control the risk in the meantime. Right? That type of trading, though, you have these assumptions. IV will drop at its first opportunity, I believe that. Right? That's mostly how we trade implied volatility option pit, meaning it will drop at its first opportunity. Do you notice I say first opportunity? I don't say that it drops all the time, right? I chose the words carefully. First opportunity, right? First opportunity generally means everybody takes their head, they pop out of a hole, and they go, oh, the smoke is clear, I'm going to start selling. Okay. My next one is semi-Newtonian. Realized vol stays the same until there's a reason for it to change. Donald Trump gets elected, volatility in the market goes to 8%, hasn't changed. Okay, you can keep buying the VIX all you want, just hasn't changed. Right? Something could happen, hacking, this, that, I don't know, whatever. Right? That could change it. But right now, there hasn't been a reason to change, right? So guess what's happening with market volatility? Right? You got the pundits and like they're underpricing and underpricing. Well, all they're doing is they're pricing what they see, and they're pricing what they're seeing is I don't see a whole lot going on. Okay. Another basic vol assumption today: if I go to sleep and the realized vol is 8%, I'm going to assume it's 8% tomorrow. Okay. Remember, you trade for what you see, you hedge for what you don't. Okay. Ultimately, realized volatility will rule. Okay. You could have the greatest sale of options in the world. Okay. But if the stock starts doing crazy things, doesn't matter. You'll lose. Okay. This slide is 25 years of trading in one slide. Yes. Right. The problem is, since I didn't write a book, I don't spend hundreds of hours of back testing and all the other stuff. Right. You just have to assume that this is what I think it is. My track record is pretty good. You can take it or leave it. Right. But this is essentially what most of the people that I know that are still trading think like this. Okay. Now, when realized volatility is in motion, it tends to stay that way. Very important. Meaning, when VIX is 11, it's low. But once it starts moving, that changes things for me. One of the most important things as a signal is change in pricing. That's key. Because also, when we look at trading volatility, that opens your opportunity side up tremendously. Does that ever make sense to everybody? Those are specific things that we will learn to price for a position. Right? But we're going to assume that. Okay, vol is 25 today. It's going to be 25 tomorrow. Realize vol will be 25 the next day until something changes. But we will price for that. Okay, why is trading volatility interesting? Did you guys notice that picture of the VIX? Okay, what's the one thing I didn't say about this slide? Does anybody recognize the percentage moves per year that the VIX moves in 1 year? 200%, down 100%, up 200%, down 150%, down 90%, down, what is it? 80%, sorry, 75%, up 20%, down 20%, up 100%, down 100%. Do you guys see the relative moves for VIX? Name one stock that does that. Can you think of any? Not Tesla, not even close. Not even close. Not even close. Okay, you're all no. Maybe the craziest bunch of buy. But I'll put. How about this? Name something that you can think of that trades like that normally. Apple. Thanks, Bo. Now you've been around long enough to be a comedian. Apple's the opposite. What is it? That's like the anti-VIX trade. All right. So why is trading the vol products interesting, right? Because the vol products, why do we trade them? Right? Because they move in certain ways, right? So if we're going to buy options, my rule with buying options is what? I want to have above standard deviation potential for movement, right? I want to pay $1 where I think the underlying movement is worth 3, right? VIX gets interesting when it's trading 22 because all of a sudden, and the vol goes up for sure, okay? But what you'll see is they almost never price the moves properly with VIX because they never can really make the IV that high, okay? That's why it's interesting, right? The relative moves in vol tend to be bigger, which makes it more interesting for us. Right? Because if you want to trade options to move, you want something that's going to move. Does that make sense? So what you're going to learn is you cheat movement. Right? You can cheat the way things move. Okay. Next thing here for me, I always wait till the IV moves first. You want to save yourself a lot of headache. Wait till the IV does something first. Wait till it gets cheap. Wait till it gets expensive. When it's kind of hovering around in the middle of nowhere, you don't care. That'll save you about 90% of dumb trades. Right? I still make them sometimes, but I don't make them as much as I used to when I was young. Okay. Now, why is trading vol interesting? Because the trends tend to be solid. Right? When VIX is 30 and the vol starts going down, it crashes. When VIX is 12 or 13 and all of a sudden there's action that's making the vol go up, it's a powerful upward force. So the good thing is you're rewarded for a move because it's going to move. But the important thing is it needs to start moving first. Is that key to everybody? So this is also, Andrew, this is important, slide number 2. See, if I put this slide at the beginning, you'd all leave and there would be no more presentation. But I figured I at least have to explain the stuff that's in the slide first because we got new people. Right. So I'm running over time as usual. However, so the next thing, there's only a couple more things. Concept-wise, okay, just looking at standard deviation of the straddle, this is what I want you to know. The straddle is what the market thinks is the most likely move for that period of time right now. Does everybody understand what I just said? So if I'm looking at the 214 straddle and SPY, that's what the market thinks the underlying is going to move most likely for that period of time. Does everybody get that? I'm not trying to say anything crazy about that. That's the assumption we're going to make, though, when we look at a straddle. When I say price that 214 straddle, what does that tell me? That means the most likely move will be $1.70 or less, $1.71 or less. Does everybody get that? Nothing crazy. Okay? Your best pricing signal is the at the money straddle, almost always. Okay? Does that mean it's right? Nope. But that's what a crap load of people think it's worth. Doesn't mean it's right, but that's what it is. Now we take that and then we use it. Right? So the rest of our class, when we start talking about pricing projected moves, pricing straddles, what's the market pricing for a 3-week move? What's the actual move really have a shot to be? And we try to put a trade together. That's what we're going to go to. That's the reason. Right? The reason is that's basically the market's. It's not exactly, but it's close enough for us that's basically one standard deviation. Most of the time, it will be that. Okay? Most of the time. If the implied volatility is what? Is this the same as MMM on TOS? Probably, Scott. Let me take a look. Do you mean this guy right here? So this is the standard deviation here for TOS. That's the actual standard deviation calculated. Yeah, the market maker move on TOS, it might be. But this is a standard deviation, but this standard deviation, remember, is always based on a what? On a volatility, right? Does that make sense? Okay, good. Okay. Straddle summary, I just said all this. The most important thing with your straddle is it's hugely volatility sensitive. You want to pick something that's hugely volatility sensitive, it's a straddle. Now, I don't mean Vega per option, because that doesn't change. But what I mean is the value of the straddle can go from 1 to 2 to 4 to $10 just by a change in vol. That's all you need to know for that. Okay? Massively volatility sensitive, but it's the market's best guess right now for that time and that vol. Okay? So, right, as we kind of get to the end, again, this is just intro concepts and terms. Right? The thing is, for our class next week, you're going to have to understand these slides. If you want the slide deck, send me a note at andrew@optionpit.com. I'll be happy to send it to you. Okay. So the vols that we're using, realized vol, implied vol, at the money vol, out of the money vol term structure, that's all the stuff we use for trading vanilla, what I'll call vanilla options. When we trade the vol products, okay, the vol we use is the VIX to the VIX futures. Does everybody understand that? They're not necessarily the same things. Okay. When we said earlier, what is the VIX future the best guess of right now? If you were, I know there's a lot of information, but what's the VIX future the best guess of right now? Right, the forward vol. So if I say this, or just what we're saying is, you have the VIX, which is the implied vol. Remember, somebody asked, say, hey, isn't the VIX futures just the implied volatility, right? Remember you guys asked that question? I think with Maurizio, you might ask that question. Okay. Now I'm comparing the VIX, which actually is the implied volatility, to what? The forward vol. Do you guys see that? Okay. Now what we want to do is we want to build a trade on that relationship. Okay. That's a different relationship than realized vol, implied vol, at the money vol, out of the money. Slightly different, right? Right. We're going to do like 9 weeks on mostly number 2, some on number 1. Okay. So this is subtle, but these are hugely important because the market prices volatility in what? Different ways, right? Does everybody see that? The subtlety of forward vol, the subtlety of implied vol, the subtlety of realized vol, right? Because that's what's going to give us our, at least try to generate the trade for edge. That's the stuff we do in option pit. I think Apple's going to go up today. Well, sometimes I do and sometimes I don't. Right? But it's easier for me to price, okay, well, this is what the market thinks a vol is. Here's what I think we can do. There's a trade. Okay. Okay. Also, I guess a famous phrase from physics, once you can measure it, you can trade it. So the important thing here for class 1 is understanding when I say future vol, what do I mean? Forward vol. When I say historical vol, what do I mean? What the underlying is just done. When I say implied vol, what do I mean? Okay. But you got to know what you're measuring before you can trade it. Do you understand that? Because just thinking the vol products are going to go up is, you might as well go back to slide 1, the normal distribution. Right? What's the one thing about the normal distribution that we really don't say what it is? It's the coin flip. Stock will be up today, stock will be down today. Right? Throw in dividends and all of a sudden the distribution changes shape. Right? Okay. Now, why do we do this? Okay, so in this course, this is important. We concern ourselves with the realized vol and the perception of a change in realized vol. Okay, as expressed by the VIX and the VIX futures and all the products that are connected with them. Okay, do you understand the theoretical background for why we look at things the way we do? Right? It's what we're trying to look of is what things are worth and what a perception and a change is going to be worth to us. Right? So if they're going to pay me money because I think, or what's reasonable, that things are the way they're trading right now or not going to trade this way for the term, I might have something. So we're choosing vol as a direction itself. Meaning VIX is going to go up, VIX is going to go down, but what does that mean to the positions that I have right now? Okay? And how the market, so we'll get very granular with the vol products. We'll get very granular with pricing those, pricing them over time, putting trades, putting pair trades together, putting hedge trades together. Okay? We'll be doing that by class probably 3. So for today, this is what I want you to do. Okay? Yeah, I want to price 2 volatilities against each other. Okay, so what I want to do is, the hardest part with the trade right now is there wasn't great things to do from a vol trade point of view. It's just the way it is. So what I decided, instead of something that I love as a trade, I'm picking something better to watch. Try as I might to find something that was really interesting. I was either looking for a long-term vol to buy, or I was looking for something a little more juicy in the vol products. It looks like we're getting a little bit of a rally in VIX, but we didn't get enough to make it, I would say, tradable. But a spread for me means to just buy low volatility and sell higher volatility. Okay? That's all it is. Now, the thing is, there's tons of ways to do that. You could create butterflies. You can trade option spreads. You can create regular pair trades with like things. You could trade VXX versus VIX. You could trade SPY versus VIX. You can trade SPY versus VXX. It's infinite, right? There's lots of stuff you can do. So, but first we want to figure out kind of how to identify a couple of things. So what I want to do is I want a trade to watch per week no matter what. So this is what I'm choosing for this week, okay? And we'll write it down, right? Because again, when you're trading or teaching trading, if you don't keep track of stuff, I don't think it has value. It's stupid. Because you want to see if you're right. Add a slide. Okay, so we're going to add a slide. Okay, so here's our vol pair for the week. Okay. So there's a couple things going on. So one is, Okay. This is what I'm going to just call reading the screen straight up. Now, do you guys see the 10-day volatility here in the SPY? You see the 20-day volatility and the 30-day volatility, right? So for the last 30 days, realized vol is 7% in the SPY. The last 10 days, it's 6%. That's probably as low as it's been in a year. Okay, so let's just take a look at that. There's 30-day vol. Not as low as it's been, but it's pretty damn low. Okay, 10-day volatility, which is the white line. We're it's about as low as it can get. Okay, needless to say, it's pretty cheap. So the SPY isn't moving. Okay, so something's not moving, and generally I want to be gamma positive or gamma negative. Okay, if something's not moving, do you want to be gamma positive or gamma negative? You can guess. You're close, Wayne. Not theta positive, gamma. Right? If an underlying is not moving, I'll say it again. The underlying is not moving. Do I want positive gamma or negative gamma? Negative. The stock is not going to move for 4 weeks. Do you want to have long gamma or short gamma? Not moving is negative gamma. So what I would do is express this, let's say, with a butterfly. Something that's going to have almost no gamma to it. Right? So let's say I decide I want a simple fly here. Oops. So one standard deviation is about $3. So I'll go Feb 3. So I'm going to buy I'm just going to buy a butterfly as a hedge. Let's say a 5 lot. Okay. 225, 220. Okay. And then I'll buy 5. Okay. Again, flies in general are not really gamma positive trades. They're gamma negative trades. But this one's going to cost me 53 cents. Okay. And I get, again, if we drop, I get slightly negative gamma. Right now I have slightly positive, right? But it's actually providing me positive decay, right? So if something doesn't move, you don't want it to cost you money, right? If I'm going to say this stock is not going to move for 3 weeks, doesn't that form an impression in your mind of the type of position you want? Well, exactly. So this is a good point, Ben. Ben's saying, however, many times when it's calm for a while, it is like the calm before the storm. You can get run over with the vol explodes. So what we're going to do is we're going to price for the thing we see, which is what? The SPY not doing much, right? That's what we see. So in this case, I'm going to add, we're going to have the SPY. All right, this is going to be a pair, right? SPY Feb 03, 225, 220, 215, put and fly for 53 cents. Okay, we're going to buy that 5 times. Okay. Now, the problem is, this is not what I'm going to say is the money-making side of the trade. Right? Mostly because, sure, the market could go down. I'm not spending much for this. That's fine. Okay? And this is what I want you guys, this is why this is a trade to follow, because if you're new to kind of doing this stuff, it's not totally obvious. What I'm going to do is I'm going to pick a term for, let's call it VIX. Let's use VIX. Okay, I'm going to use the Feb 08. Okay. Now, do you guys see VIX is trading 1187? Right? And the Feb 14 put is trading, let's call it $1.30. So do you guys understand what's the intrinsic value of that strike right now? Right? It's $2.17. Does everybody see that? Right? This again is slightly a little bit more advanced than I want to at this point, but it's mostly just something I want you to follow. So if I buy a VIX Feb 14 put here, okay, Feb 1408, 14 put for, let's call it $1.40. Okay, so we have basically two sides though. We have where the market goes down, we make a little money as long as the market doesn't go down what? Too much. Right? I'll change the ratio a little bit. Okay? However, if volatility drops in the VIX, right, or actually more important, right, this right now is pricing a future volatility of 1385, right, that forward vol. If this forward vol becomes, that perception changes, and the volatility starts increasing, what's going to happen to the price of this future, right? It keeps dropping, dropping, dropping. It'll go somewhere toward the VIX cash. Who knows where that goes? Right? So what I want you to do for this first trade, again, I wish I had kind of a more vanilla pair. This is not, because I would just call this an advanced trade. I'll just say it right now. What I'm saying is one side or the other should pay for the trade. I should either cash my flies in because the market falls apart, or nothing happens at all and everything stays the same. So if nothing happens at all and everything stays the same, does this trade make money? So your homework is, if you're new to this, to answer that question for next week. How do you determine the ratios? Because if I'm right on my SPY fly, let's say we make our max gain, what will we make? Right? $400 a fly, Michael? So how much would we be up on that? $800? Right? So you figure that's going to pay for all my VIX puts because I'll be dead wrong on those. Does that make sense? Can we do a SPY straddle and short Vega with VXX to be Vega neutral? Yep, you can do that. Which SPY straddle do you want to buy? We can follow both. The problem with buying this, what's my problem with buying the SPY straddle right now? Just going through what we just talked about. If you make the assumption that things are going to remain how they are, would you buy a straddle? Right? A SPY straddle 3 to 4 months away. I'm not going to say that's wrong, but that's a different trade. Because now what you're entering in is, Vojo, if you think about it, now you're buying Vega 3 to 4 months away. Why do you want to hedge Vega when VIX is 1187? Right? So what he's trying to do is say, yeah, well, I want to buy some VXX against that. But if VIX is already 1187, how much vol risk? Do you want to hedge long volatility risk when VIX is down here? Right? No. Maybe sell out of the money call spreads with VXX, right? And then you have to pick what's the term. So when you think about it, Vojo, when we're trying to put these together, that's why we'll do that kind of pairing later. But you're buying a straddle that costs, $85 per straddle. How many call spreads you have to sell? your question is right, but you got to think about I've got to sell 500 call spreads to hedge my vol risk. You see what I mean? Doesn't that sound kind of unbalanced as a hedge? What's the one thing about this trade that you notice? Okay. Does the trade that makes us money probably, remember, if nothing happens, right? Nothing happens. I'm just taking the assumption that we put in class 1 and I'm trying to express it with a trade. Does that make sense? Right? The put fly for us is the hedge, but if nothing happens, I expect my 14 puts to be worth $2 or more. Right? And I'll make that 4 times versus the $2, the 53 cents I lose twice here. Does that make sense? Buying a longer. That's right. But we're going to cover that in the next session, Ben. What I'm trying to do with the session we just had is I'm looking for the things that we talked about, and I'm trying to express a trade with that. So you can buy a straddle at the bottom of the range, right? But one thing you're going to learn in our class is how do you pay for it? What's your financing mechanism for it? Does that make sense? I'm not saying that buying that VIX at this level long term is wrong. I don't think it is wrong. But then what are you going to do? How many people have bought $90 straddles in here? The decay is exciting. But we will price that. What I want you to do is follow this pair. Right? Follow this pair. That's the idea. Right? Again, expressing what we see, not a lot of realized vol, and VIX futures that are trading at a premium to wherever the cash is. Right? So if the forward vol happens to be right, my fly pays us. The question about this hedge is that if the market goes up, you will lose on the butterfly and on the vol hedge. So the vol trade is actually the money-making part, and the fly is the hedge. If the market goes up, I don't expect VIX to be higher than it is right now. Does that make sense, Ben? So what I want you to do is work this out and tell me why I'm right. So then this will work. Right? This is your very small homework. Why does this trade work? Right? All we're doing is looking at implied vol, realized vol, and coming up with positions for that. That's all we're doing. We're taking what the numbers say and just coming up with a position. Okay. If you want it to go longer, you can match the term for sure. Doug, that's fine. One thing I will say about butterflies, though, butterflies always work better to generate dollars when the term is shorter. When you increase the term, they don't deliver the dough as fast. Right? So that could be a market. That's how you could actually make a market call. You just change the term. So do you guys see how you can add the nuance to this stuff? You can have an opinion on the market, but you don't have to have a direct delta. You just change the term on a pair. That way you can be wrong but still be right. See, aren't you learning something? All right, we'll see how this pair looks next week. All right, here's our summary. All right, now you know how to measure vol, so that's going to be your job. Right, to trade vol, you want to have to explore the disconnect and option prices versus where in the wave. Okay, where are you in the cyclicality part? When you trade the vol products, you got to include the futures. Right, we'll separate those. Right, they can rejoin when we create pairs, like I just showed you, and we'll trade one volatility against another. Okay, that comes in many forms. Send me questions, andrew@optionpit.com. Okay. Hopefully you learned something. If not, I have the opportunity to confuse you next Tuesday. If you have questions, just send me a note. Okay. This will be posted probably within 45 minutes. Or you can go look at it again. You're buying the butterfly and you're buying VIX puts, Ben. Take a snap of that. Right. Sorry, sometimes I forget. If I say it's +4, that's buy. I put a negative in front of a sell. That's the old market maker in me. I'm efficient. Right? The important thing for you is to just follow the trade for 2 weeks and see what happens. Okay? Like I said, I would have liked this trade a lot more when we were trading 12.5 or 13 VIX earlier, 12.5 this morning. So max loss would be if it crashes. Exactly. You would lose your fly premium, but you still might be able to get out of it for something. And you would lose your VIX put in case we uncrashed and it came back. So vol would have to go where the ugly spot for this trade is would be, below 215, 2015. Does that make sense? So now if you thought the market was going to crash, what would you replace the fly with? You buy a put spread, right? So you express your opinion by really what that hedge looks like. I don't expect a lot to happen, so maybe I'll just buy a put spread instead. But as soon as you buy a put spread, you have to change the ratio. Do you follow that? Like I said, it's not. Unfortunately, this is not a vanilla trade. This is a little more complicated. You determine the ratio how one trade pays for the other. So if my assumption is that realized vol stays the same, I'm expecting the VIX put to pay for everything. Right? But they've got to make money either one. If everything goes fine for VIX, we're trading 1150, I make $400 or more. Right? It's also possible that you can close your VIX put spread, your fly. Right? Let's say it's up 215 or something like that, 225. You dump one, the market goes ripping back the other way, and vol collapses, and you make money on your VIX put. Okay. By the end of our class, you will create these yourself, because you'll just be confident in seeing what the market's giving you. Okay? I only ran 41 minutes over. I'll try to be a little more timely next time. All right, guys. Have a good one. And it'll be class 2 next week. We will go through Vega. Vega in time. All right, guys. Have a good night.